So stock started strong today, and we continued up to a new high, new 4-week high, before pulling back and finishing pretty neutral by the end of the day. But today's pattern sets up an interesting potential reversal pattern. So I'm going to break that down, as well as some other technical patterns that are still developing from previous videos. I'm also going to break down this rotation that's going on, what we're rotating out of, what we're rotating into, and why that matters. And one of the areas that we're rotating into, there was a good buy signal on a stock, on a big popular stock, that I'm going to take a look at with today's trade idea and show you a way that you can buy it in a quote-unquote high probability way. So let's go ahead and get started. Today is Wednesday, November the 29th, 2017. My name is David Settle. This is my market outlook for the day. Thank you very much for watching today. Welcome to those that are watching for the first time. Hope you keep coming back again and again. Subscribe to my YouTube channel. Hit that red subscribe button right down below the video. Also, hit that thumbs up right below the video. Let me know that you like the video. It's a one-click, easy way to give me feedback. Scroll down to the bottom, comment on anything that stood out to you from today's video by commenting in the comment section. You'll also see down below the video the description section. You'll see links to my Facebook group, Facebook and Twitter, as well as today's Market Outlook posts on Twitter and Facebook, as well as a link to join my daily email Market Outlook newsletter that contains a timestamp summary of everything we talked about in today's video, as well as a list of all of the overbought and oversold clusters in the S&P 500 today. Follow me on Twitter for more content in addition to these videos throughout the day. You'll see my Twitter handle on the screen at DavidSettle42. Pinned to the top of my timeline is today's Market Outlook tweet. Go ahead and click on that heart and the retweet button there if you think other people should check this out. Also, join our Facebook community, our Market Outlook community on Facebook. You'll see the link also on the screen there, as well as the link to that is also in the description down below. All right, well, let's take a look at the S&P 500 today. A little bit of an interesting pattern here, a little spinning top. Remember, so we had this big candle yesterday, and the discussion yesterday was, how much does it look like March, the beginning of March, where we had March 1st, we had a kind of a blow-off top. Didn't have quite the volume, but we were close to a cluster, similar to what we saw then. Very mature, bullish posture, which continues to be the case. The posture is strongly bullish. But as I said before, we're going on 3 months now, which is mature, very mature, intermediate trend. Excuse me. You have the near-term lines up in the reversal zone. It's up in the upper half of the chart. I mean, the near-term line has had quite the run here. So you had a good strong run to start the trend, which is normal. Then we had like a 20-day run here, where we didn't get enough of this area to bring the near-term line down. So we had quite the near-term rally before we ended up with that engulfing pattern and a near-term pullback there. And then we had, pretty standard, pretty solid run at 12. I believe it got to be 12 days during that rally. In fact, it was already pulling back while the near-term line stayed in the upper half of the chart. That downward move right there below the moving average brought it below the midpoint. And then from this day forward, back above, we got 1, 2, 3, 4, 5, 6, 7, 8, 9 days now. So we haven't really had, one of those kind of, near-term moves that we typically start to get at the end of these intermediate runs, where it's only like 2 or 3 days in the upper half of the chart. And of course, maybe the near-term line won't get won't get into the upper reversal zone. We haven't started to see that yet, and that's what we start to see when the trend gets weaker and weaker. And of course, market sentiment still riding along that 90 level, which is very, very high to say the least for this particular indicator here. So needless to say, the long-term trends mature. You can see that we've really, for that matter, we've gone. The market sentiment line's lowest point that it got to was back here when it got below the lower half of the chart. That was its last significant market sentiment low point. The one before that was obviously over here. But so from here, so that was pre-election, and since the election onward, market sentiment's been on a strong bullish trend. I mean, a couple of weaker pullbacks during these intermediate lows, but nothing that would change. Nothing that would change. That brought the market sentiment down to the lower half of the chart, where you'd say, okay, so that's quite the rally here. Again, off this market sentiment low here, up until and this is roughly because I'm not right on those lines. Oops. Well, you can see it's about a 26% return, about a 24% annualized return. That's a pretty good rally, and you can see the trend line formed here. We started to get this trend line right here. We broke below it. Now we're kind of riding it for some resistance on the upward side. Get rid of that line here. There we go. All right, so we continue to have a bullish posture, bullish near term. Again, all mature. That's a spinning top candlestick pattern, which again is a neutral pattern. But when you get it at the end of this kind of a move, I mean that could be a precursor to what's called an evening star candlestick pattern, where you have a big, usually at the end of a near-term run, or you never know when it's the end of a near-term run. So I guess you would say when you've had a pretty decent near-term run already to get to this point, and you've had a kind of a blow-off move, then you have a neutral spinning top doji type pattern. The third day of that pattern would be a downward move that doesn't necessarily completely reverse this bullish move, but gets to at least a halfway point. So we're looking at, potentially 26.15 in that area that you'd be looking at to get to on any kind of pullback. And of course, again, that would not be much of a pullback. In fact, it would essentially be a move down to what, the 23% Fibonacci retracement. Yeah, maybe down to 23% Fibonacci retracement in that area would be the pullback. I mean that would be an evening star candlestick pattern. Of course, the intermediate trend that continues to move that up higher too, and you can see that a move down to 23% would get us down to the 23% intermediate retracement. Basically, get us down to the moving average right now, to this range there. If it occurred on this current run, it would just be a 62% retracement of the near-term run, so it could still hold support. So you can see, we can get an intermediate-term pullback, and it would not be that big of a deal. Okay, one thing that does look a little different, though, is the NASDAQ. So the S&P, the NASDAQ's been doing very, very well. In fact, if I were to take a look at the NASDAQ composite, NASDAQ composite on a relative basis to the S&P 500. Give it a second to load up here. You can see that it has been doing very, very well. This again is over the last couple of years, and of course, here's the November 2016 election, and pretty much all this year up until just recently. The NASDAQ's been outpacing the S&P 500 until November the 24th. That was the last day. Now, if I just take a look at the NASDAQ by itself, you can see there's November the 24th. So the NASDAQ relative strength to the S&P started to turn over these last 2 days, even though the NASDAQ itself hit all-time highs, and then boom, today. And again, all this today's selling in the NASDAQ has also been tax reform related. That's a lot of these big tech companies. A lot of these big tech companies are not, they're seen as to not benefit as much from the current proposed reform. You can see there was this great article, and I'm sure it was probably in some kind of compliance or review, but this article talked about just how insane those stocks' run has been all year long, and maybe he saw that underperformance in the last couple of days. But it was interesting that this came out today, on the day of all days, that these stocks really led the way to the downside. And that was a tweet that I put out here earlier today as well. I'll give it a second here to come up. There we go. How financial stocks really killed it today, and you'll see that here by the end of the day. But by early this morning, they were really doing well. Technology, not so well. They were the one outlier, along with these safe haven areas, to the downside. And again, I remind you that correlations in the S&P 500 get very low when the markets are bullish, when the bullish trend is very mature. which means that there's going to be rotation, different leaderships at different times leading the market higher. And technology has been the leader. Today, obviously, it dropped, but the market didn't tank as nearly as much as the Nasdaq did, right? I mean, the Nasdaq was down 1.25%. The S&P was flat with that shooting star. So it didn't tank nearly as much because money moved into other places. And in the case of today, moved back into that financial sector, which has been lagging. But of course, today, really good day of outperformance. All right, so the long-term trend's still firmly intact, and we're still easily more than 100 points. In fact, over here we were 111, 110.9 points. The 50-day moving average was above the 200 by 110 points. We are now 112 points. So we are at the strongest momentum that we've had since the last time we sniffed the 200-day moving average. Again, pre-election, and you can see how bullish we've been ever since. Strong rally here. From a 3 green arrow standpoint, eventually, why my computer's so slow today? There we go. All right, so again, remember yesterday we were so far up above the 8-day moving average. It's hard to keep going that far away from the moving average. That it's going to catch up. The 8 day is going to catch up to it, and it doesn't mean that it's going to go below it. I mean, you'll eventually just catch up. Because see, even here you had a big strong move, and then we kept going up, but not nearly to the same extent, and they caught up to it. Same thing here. We rallied strongly up above, and then the 8 day caught up to it. And you can see, now here's the gap between the 8 and the 17 day. This black line, that gap between the green and the red line is very strong, getting up to be higher levels again. The stochastic, interestingly enough, turned down. Still in the reversal zone, so like the intermediate line, still bullish, still strongly. The bulls are still in control, but you can see now they're above their moving averages, but the stochastics turning back down toward its moving average. So definitely something to keep an eye on as we potentially get that even candlestick pattern tomorrow with how it's setting up so far these last 2 days. So a neutral intraday candle, because we did have the high of the day early. That's not bullish. You like that, like yesterday, you like the high of the day to be late. So we're not getting a continuation, which wasn't expected, because again, we said yesterday we probably pulled forward a lot of days worth of slow grinding moves all inside of one day. And for that matter, the last 2 weeks have been really bullish, probably more bullish than necessary, in anticipation of this tax reform bill, which again is supposed to be passed by the end of the year. So not surprising that we finished that peak this morning early. Fortunately, the low of the day was not late in the day, because that would have been bearish. It was in the middle of the day, and then we finished kind of in the middle of the range. We did finish below yesterday's high point, so a little bearish, a little less bullish. So we can that. So the two factors that are not very bullish here are the early high point and not closing above yesterday's high. Now, not bearish, because it was a higher high and a higher low, and we didn't close at the low. So it's not the bearish candle. That's, again, a very neutral doji type pattern. And you can see if we get that evening star candlestick pattern, 2615 is right in this area. So we'll start to come back down and fill in this. If that's the case, if we end up with that candlestick reversal pattern. If we by Friday finish back up around this week's low point, or this is Monday, so right around in this area, then that's going to be a long upper shadow here, because here's where we opened. We opened on Friday right there, right where my cursor is. So if we come back down and close in this area, that's going to be a small body with a long upper shadow all the way up to 263.5. That would be a very bearish weekly pattern. So definitely something to keep our eyes on how we close. Now the posture's bullish, the near term line's bullish. So the expectation is we'll probably just kind of mess around up here. But with that budding candlestick pattern and where it could go to and the consequences of it in terms of a weekly candle, now we know how what to expect and again, we expect the bullishness, but if we get that pattern, we know, despite the bullish posture, that is a bearish reversal pattern. Volume was again heavy. The range today was 1.5 points. Volume at 76 million. So put that in context here. 1.5 is still above average. 70 some odd million volume is above average. Those lines going up is not bullish. So you know, if we're going to be bullish, if we're going to maintain this bullishness for a while, then you want us to kind of grind away in here of this 2-week range and staying up in the upper half, of course, of the 4-week range. But we want to grind away up here if we're going to stay bullish with small ranges and small volumes. We want it to get boring again and bring those lines down. But if we come back down here with some bigger range again and some volume above average, and those averages keep going up, not going to be bullish. And you can see volatility. Even though, you know, the index was kind of flat today, we saw what happened with the Nasdaq. Volatility is rising. Volatility, you know, since you know, these last couple of days the market took off, the volatility has actually not gone down; it's gone up. Not only on an absolute basis, but continues to also go up on a relative basis. So, you know, again, out of this extreme low. Now, you know, that 85% mark is the sweet spot for bullishness. But you get back and you get up above that, and then that's when we start to pick up the volatility. And as I mentioned before, all the recent near-term pullbacks have been getting bigger and more volatile. And so, you know, if that trend continues, then we'd expect a near-term pullback that's bigger and more volatile, similar to what we probably starting to see in the composite, in the Nasdaq composite. As we transition to what's driving the price action today, just a reminder to click here. So this is my Twitter feed. Again, the address is twitter.com/DavidSettle42. You'll find my Twitter feed there. You'll see, if you're not following me already, you'll see a follow button right there. Click on that. You'll get more stuff that I'm posting throughout the day. And also at the top, remember, this is pinned to the top as today's Market Outlook video. Click on that heart. Let me know that you liked it. One-click feedback, really easy way to give me that feedback there, and then retweet it. And the more you do those two things, whether you have followers or not, the more Twitter will promote that post to people that's interested in this type of stuff, simply because you did 2 clicks. So I appreciate those that do that. Let's take a quick look here. You know, in addition, so I talked about the you know, this rotation, and even like this is like the godfather of technical analysis here, talking about the rotation that we're getting right now coming out of tech stocks into financials, into transports. We saw industrials doing well yesterday. There's the article about financial, the FANG stocks doing crazily well this year, abnormally well. Here's an interesting article that I think you should check out that we'll dive into a little bit more now. In the fact that we've been doing the S&P's had a very good year, but when you look at it compared to some other asset classes, it's not looking as good. Now, you know, not as bullish. If you take a look here, you can see again over this last couple of days run where things have really taken off. Small cap stocks have been the big winner. I mean, they're up almost 2% in a day. Now, you know, their rally ended this morning, but you know, the U.S. stock market is what's really been doing well for the last couple of days, and small caps in particular. And if I were just to take a look at just today, there's that rally early, but then you can see by the end of the day today, with stocks down just a little bit, that high yield was right there with it, and the dollar was right there with it. So not a very good move in the stock market. And then on the other end of the spectrum down here, international stocks getting beat up, and partly because of this volatility that we're seeing in crude oil. I showed you a chart of crude oil before. You can continue to see that weakness, convergence pattern here. And here, let's zoom out to the MACD and the stochastics indicator, and you can see that divergence setting up on crude oil. So continuing to show weakness on that. There we go. So that's bringing. See, gold's dropping because of the outperformance in the dollar. Now, and when I say outperformance, I mean the dollar actually matched the stocks. So pretty decent day for the currency when you look at it from that perspective. And of course, you can see here there's long-term treasury. So yields had a very good move, a positive move, and we'll see how that's really benefited. The financial sector. Another thing that benefited the financial sector, and this again, another interesting article I pointed out, is the Fed nominee, the Fed chair nominee, is very big bank friendly, according to this article here. And so you wonder if that might have an impact on that sector. If you take a look at the economic indicators, still looking positive. The big one today was GDP. GDP was revised. The second estimate was revised slightly higher, as expected. So we're up to 3.3%. Of course, we'll get one more estimate, a final estimate, and then we'll get, in January, we'll get the first number for the next report, and we'll get an update on that estimate, which is also expected to be at 3.3%. So we're getting kind of multiple quarters in a row of pretty strong growth without a pullback, right? Usually it's not surprising to get strong quarters, but usually you get a couple strong quarters and then you get a breather. We're getting potentially here 3 in a row of very strong quarters. So that's a good news, and that the actual data, economic data, is starting to support what the sentiment data was showing previously. The sentiment data was very, very bullish, but now it's starting to show up in actual economic data. And one of those sectors that's been really killing it lately has been the housing sector, with another strong data point today. In this case, it was the pending home sales number. Sorry, my computer's just running really slow today, but the pending home sales, here we go, that came out much better than expected. There we go, 3.5% return versus the 1% gain. So with that being said, yields, I mean, they didn't move much today, but they're still showing, better odds for a rate hike in March than no rate hike at all in March, which is what the purple line would say. The purple line is a rate hike in December, but then nothing more after that. The red line is the rate hike in December, and then another one in March. So you can see how that's really been taken off, and it's got a strong bullish trend right now. So the odds that we will continue to get rate hikes, which is what Powell, the Fed chair nominee, mentioned in his testimony, that he thinks the economy supports. And you see that in the economic indicators being as strong as they are, very supportive of rate hikes. So I mentioned before on the 10-year note, I'll bring up that chart here really quick, the possibility of a head and shoulders pattern developing. Well, nice good bounce today. Now it's not out of the woods yet, but get above 2.4%. Now that head and shoulders pattern is not so much concern. You can see if I were to go back to that 50 and 200-day moving average there, that we are, it is riding above that 50-day moving average. So as long as it stays above and continues above that, and the gap's low, so there's room for this gap to grow again on that. And if that continues to rise and gets up to 3%, which would not be unheard of. I mean, we were at 3%, but during QE, during the QE3 expansion. So if we get up to 3% again, it's going to be very, very bullish for that financial sector, which has been, like I said, lagging. So here's a sector rotation over the last couple of weeks. You can see something that really stands out, and there's your technology move, boom, to the downside, and there's your financial sector, crazy move to the upside. So it was, significantly lagging the broad market up until that point, and then in the last 2 days, your financial sector is up almost 3. At one point, was above 3%, is up 3%. There's your industrials, led by those transports doing well. Those are your two outlets to the upside. And look at technology, and of course yields is putting pressure on utilities and real estate. They're still kind of marked for themselves. They're the only ones that are lagging, but technology not just lagging, it's really suffering, and it's dropped the most. Remember, it's had the most gains, and if I zoom back out, it was all the way up until the midpoint of yesterday, one of the top performing areas, and then boom, has just really come down and lost a lot of its outperformance, to the point where now it's one of the worst performing sectors over the last couple of weeks, outside of these interest rate sensitive areas that you would expect to be weak when interest rates take off again. So now when we see, as we transition to our trade idea, one of the stocks in that industrials area, one of those transport type stocks, is FedEx. And look Look at the move it's had here today. Strong rally, 3.5% move by itself. Almost, you can see it's brought the intermediate line out of the reversal zone. It was just a smidgen below it, then it got a little bit above it, and then now out of it. And you can see, so when it gets out of the reversal zone and starts to make a run, it can get, once it gets above 50, you can expect it to make a run for a while. And so especially if the market sentiment's got a little bit of room, and it's not, market sentiment's not extremely high. Here it got up to the mid 80s when it peaked there. This one peaked at 75, so there's room for it to run. You also have, when you take a look at the 3 green arrow, whoop, not that one, sorry. There we go. You can also see too on this chart you have 3 green arrows, obviously arrow on the moving average. Spike in volume, 1.5 times the average volume. Sideways trend, relatively speaking. MACD is above, is got a green arrow. The stochastics has got a green arrow. Stochastics is getting above 50, which you eventually you'd expect the intermediate line to get above 50. The MACD is crossing above 0, which is positive. Usually this line doesn't grind up; it jumps up, hits up to high levels, and then grinds down, right, as the market keeps going up. And you can see the 8-day, this getting above 0 means the 8 days getting above the 17. And of course, the next step would be for both lines to get above the 17, and then you've got a good rally here for a while. So there's opportunity here. You got 3 green arrows and the spike in volume. There's that opportunity for a potential move for a while in FedEx. So you can say, okay, well, I could go ahead and buy the stock. But there's a way that we can try to increase our odds. Like when you buy a stock today, you have a 50-50 chance of making money. Tomorrow it goes up or goes down. You're either making money or losing money. There's no time decay. There's no volatility. The vega is 0. The theta is 0. The delta is 100 if you buy 100 shares. Delta is however many shares you buy. And there's no gamma. So that delta stays until you add more shares or take shares off. That delta stays. So there's a way that we can improve the odds, not to 100%, of course, nothing ever is 100%, but if we were to say, okay, let's go ahead and buy the stock, but we're going to sell this covered call at 240. That's a decent ways away, and as you can see, it's above the 230 resistance, so there's some room to the upside for this to grow, and I get $2.21 50 days out, so we'll go ahead and we will buy. So you notice I right-clicked on the bid price, but I'm not going to sell that option. I'm not going to sell this trade. I'm actually going to buy a covered stock, which means I'm buying. Here, I'll get rid of these here. Delete. And then, whoops. Did I just get rid of all of them? I didn't. And we'll delete this one. So I'm buying 100 shares of the stock, and I'm selling one call. So basically, I've reduced my cost basis from 225.93 to 223.61. So I've improved my odds of success, right? If we go down a little bit tomorrow, that's okay because I've got this short call. I've got that $2.21 a premium that I've reduced my break even. If I just buy the stock, my break even is right here where I buy the stock. But by selling is an option, I've removed that, I've pushed that down $2.21. I can push it down another $4.75 by selling that put. Now you notice if I were to take off this put, because that put's a bullish trade too, right? So if I take off that put and just put through this trade here, well, with the margin account, this is a paper money account, right? But with the margin on this, I don't have to put up the whole cash to get in the trade. Typically, you only have to put up half the cash for a stock trade. So you can see my buying power effect is half of what the option is. And of course, I've got this short call that I don't need more cash for because it's covered. It's completely covered. If that stock goes to 0, I'm not going to lose any more money than I would have already lost because the stock, I'll just make that $2.21. If it goes up, then I'll sell the stock. So there's no real increase in risk from the covered call. Just the fact that you're going to give up any potential rewards. In this case, past the 240 mark. I'm going to sell this. If this stock gets above 240 by January, mid-January, then I'll end up selling the stock at 240. That's okay, right? Because remember, the intermediate trend's bullish, mature on the market. The long-term sentiment's bullish. So we're not expecting this to like take off for multiple months, right? Because that's not the market environment that we're in right now. But now you can see, okay, if I put on this short call as well, now if I hit that confirm and send, you can see I've added about another $4,000 of buying power effect, because I got to cover the margin requirement for that short put too, in addition to the margin requirement for the stock, to buy half of that stock. But now I've reduced my cost basis by $2.21 from selling the call, and $4.75 from selling that put. So when you look at it from this perspective, I've just increased my odds of success from 50-50. You know, right here, this is where the break even would be right now, and would stay there if I just bought the stock. I've moved it all the way down to 219.42. So when you look at it on the chart here, there we go. So if you look at it on the chart, whoops, thought I had that here. Let me do this one more time. Let me bring that slices to charts. And I'm getting a new computer that's going to help a lot with how fast these videos get created and how fast my computer moves here, so I won't have these issues forever. But you can see there's your break-even point, and there's obviously going to be some support in this area here. So essentially I've increased my odds of success, and I've got a little. If we stay here in this 220 to 240 range and just trade in this area, I get to keep the 100 shares of stock. I get that $2.21 plus the $4.75 in credit. I get to keep all that, and I get to do it again. I get to sell another call, sell another put again, and that's called a covered strangle. So in other words, I sell a call and sell a put out of the money in both cases. So it's a strangle, but it's a covered strangle because the call is covered with 100 shares of the stock. So as long as we trade in between, then I just get to keep all that credit. And essentially, like I said, I've already reduced my break-even point from just buying the stock by the $6, almost $7 combined between the call and the put. If it stays in this area and I get to do it again, then I get to reduce my cost basis again by however much credit I pull in from the next strangle that I sell once this one expires. So you can see how it's a way for me to be bullish in the stock, but give me a little bit of time decay. Here, let me get this to the current price. Give me a little bit of positive time decay. I do have some negative Vegas, so because I am short these options, and I've reduced my delta. So now instead of my delta being 100, I've reduced it down to 35 with very minimal gamma that will change. So in summary, the market took a little bit of a breather today as expected because we were so far above a lot of these moving averages yesterday with yesterday's move that we pulled forward some bullishness. But a little bit of a too big of a range even. As neutral as today's move was, it was a bigger than average range. Volatility continues to go up, and there's that possibility of a candlestick reversal pattern in there too. As the market is shifting, it's rotating from sectors that led the way during this current run to new leaders, including including that transportation industrial sector where today's trade idea came from. And with today's trade idea being a way for us to be bullish and buy a stock, but do so in a quote-unquote high probability way. So thank you very much for watching. I really appreciate your time tonight. Remember to like this video, hit the thumbs up on YouTube, hit that heart on Twitter, like it on Facebook. Also remember to subscribe to my YouTube channel, follow me on Twitter, join that Facebook group. All the links that you need are in the description of this YouTube video down below. Again, have a great evening, everybody. We'll see you all tomorrow.